I am very excited to welcome back Andy Schectman to the show, who has called all the chaos we've seen. He's called the crashing stock markets. He's called the sticky, spiking inflation. He's called the geopolitical turmoil. So we're going to walk through some more news stories and see what is next. Welcome back, Andy.
Good to be back again, Elliot. Good to see you. It's been a long time, so long overdue, and happy to be here. Thanks for having me.
The first one we'll cover. UK inflation hits a new 40-year high of 9.1% as food and energy price surge persists. We know inflation in the United States is very close to this, and all around the world, there's nowhere to run. What is your take on the inflation story?
One of the things that the U.S. has done a good job of exporting, because we've killed our manufacturing base. People say we don't export much anymore, but that's not true. We've done a hell of a job of exporting our inflation all around the globe. In the United Kingdom, as an example, inflation is high as it's been since World War II. Same thing in Germany, same thing in Japan. We're seeing inflation all over the place. This is not just a North American phenomenon. What you're seeing is that the numbers are grossly understated, I guess, is the bottom line here. And so when you see a 6% or a 7 or an 8% CPI quoted right now, the core CPI, which excludes food, energy, and housing, you're really talking 13, 14, 15% as measured by, or maybe a little bit less, 12, 13, 14%, as measured by the way they used to calculate inflation prior to 1980. So they're understating inflation. And certainly here in the US, I don't know that they're understating it in the UK or not, but this is a big deal, and it's something that I think all of the world's governments are trying very, very hard to get in check.
Speaking to governments trying to fight inflation, I think what we have going on right now is, obviously, because of this attempt, markets are crashing. We have this out of Forbes. Stock market could crash another 20% if US plunges into recession. And there are industries that are at risk, which include technology. So what is your take on kind of the epic turmoil and mess that is being caused from this inflation?
You know, we've talked about before the external factors that could really speed things up as dollars are dumped, and in particular, the questionable loss of the petrol reserve status with our relationship with the Saudi kingdom, and the potential of OPEC opening up oil and other currencies would exacerbate that dramatically. Bottom line is, yes, I think that there is a likelihood that as rates rise, we will go deeper and deeper into a recession. The question becomes, what is the Fed's response after the recession and after the pain starts to get hard, more and more and more severe? Do they come in and reverse course? And that is still up in the air, but I think the betting money says that they would.
Wow. Yeah. Because the question is, how much more can we take? Everyone's 401ks, all the baby boomers' retirement accounts are just collapsing right now if they're in stocks and bonds, which almost all of them are. So governments have always had to pick between economic depression and inflation. I think 100% of the time they've picked inflation, probably.
Well, and the worst part about what you said is stocks and bonds. I mean, you got a 60-40 split has been the mantra for Wall Street forever. And when you look at it in that light, it's not just you and others who have managed accounts where, their accounts are falling. But what about the pension funds? And the insurance companies who also invest in stocks and bonds? And for most of my career, most of my life, stocks and bonds were inversely correlated to one another. It was risk on in stocks, risk off in bonds. And that's why you get the 60-40 split, to kind of mitigate the risk. And as you get older, you transition more to bonds because it's supposed to be less risky. But the problem is the Fed has created this environment of low interest rates for so long that stocks and bonds have lost their inverse correlation. They are both positively correlated to one another, but inversely correlated to a rise in interest rates. If rates rise, you're looking at that religious moment where everything collapses under the weight of rising rates. And so I guess we'll have to see how far they do push it. To your point, how much pain can we take? Well, I guess I would look at it another way and say, people's statements or the value of your home or all of these things that have gone parabolic are illusionary. So we have gone the other way so far to make believe land that in order to find a semblance of price discovery of reality, we have to have interest rates where they should be, where the interest rates are set by the marketplace, not by the central planners who have distorted everything and created massive misallocations of capital and resources that have created these imbalances. And as things start to find their equilibrium in Mother Nature, in nature, I think you'll see a good deal of pain. And that's the question. The $1 million question is, when does the Fed jump back in and reverse course, thereby losing credibility? And I think that's a corner they're backed into that really there is no easy answer, but just to see how it all unfolds.
Yep. And what makes matters worse is the geopolitical tension, the war going on right now, which doesn't seem to be going anywhere, unfortunately. Kaliningrad, Russia warns Lithuania of consequences over rail transit blockade. Do you think this war will escalate? Where are we going with all this? Because it's just making the economic situation way worse.
Well, Kaliningrad is sandwiched between the EU and NATO members, Poland and Lithuania. This is a powder keg waiting to happen, and our crap-ass media doesn't do anything about talking about it. I haven't heard a word about this on any of the major news channels, and yet this is about as big of a provocation of war as you could ever ask for when you see, a country blocking what would be things that the EU are sanctioning, like coal, metals, construction materials, technology items, things that Russia needs for her infrastructure. They're not happy about this, and they are certainly rattling sabers right now. So, every day we get closer and closer and closer to some sort of a moment. And God forbid, this is not the moment that any of us need right now when you talk about geopolitical issues. And you know what? If this were the U.S. and this was being, we were being call it, somewhere in South America or Central America or Mexico or whatever was blocking things, it would not be handled just delicately here, I think you can say. And so you can put yourself in the place of the Russians, and I don't blame them for being upset about this. We continue to poke the bear, and this is something that I think is frightening and is bringing us that much closer to World War III, God forbid.
Exactly. And so, the last kind of shoe to drop in your prediction is gold prices. It has been a very stable safe haven in this crazy environment. It's been steady. You've seen stocks go in a roller coaster, but gold has been steady and a good store of value in all this. And so we do have this fear-mongering article about, you could argue, saying Uganda says exploration results show it has 31 million tons of gold ore. My first question is, sure, but at what price? Like, how much will it cost to get it out of the ground? Because miners need a profit. But what is your take on this? Does this speak to a big inflationary gold supply coming on the market or no?
The claim is apparently based upon airborne surveys and geochemical footprint, but there hasn't been any drill testing in the areas or positive geophysical surveys. Look, to me, this is just puffery, if you will, designed to attract mining investment in the country. So you could argue the numbers thrown out are reckless based upon actual evidence, and the evidence shows that there is potential to host gold mineralization. And if there is potential to hold gold mineralization, at what price does it come to extract? A friend of mine, Dave Kranzler, and I were talking about this, and he wrote something very interesting. And he said, I guarantee the Colorado mountains have a total of 31 million tons of rock that contain 320,000 tons of gold, but it is gold that would never be worth spending the money to extract. I thought that was kind of an interesting analogy. So yeah, you may have mineralization there, just like you may have it in the bottom of the ocean, but what does it cost to extract it? And so I think it's the old putting the cart way in front of the horse type of deal right here. So there's a lot to be seen on that, and very little to substantiate the claims at this point.
Wow, that is such a great point. Yeah, there's gold everywhere, but it'll cost an absolute fortune to get it out of the ground, and prices need to rise if any of that's ever going to be brought out. And so that is a great, great point. And also, you're right, the Colorado Rockies. We could talk about that all day. How much gold is in the ground there and in the ocean? Great point. Okay, so then, I guess, what is your thesis on gold here? Because obviously, yes, it has outperformed almost every other asset in this collapsing market. How do you think the price action plays out going forward in this terrible mess of a situation that we're in?
In this environment, Elliot, he or she who loses least wins. And I think that you can look at all of the cryptocurrencies down, anywhere from 30 to 70, 80%. You can look at every indice, the S&P, the Russell 2000, the Dow Jones, the NASDAQ. They're all down 20 to 40% year over year, yet gold is up a couple, 2-3%. Gold is doing what it is supposed to do. It's holding its own. Gold is wealth. It's not intended to make you wealthy. And when it does make you wealthy, it'll come at the expense of the US dollar. Unfortunately, the market price is controlled by the commercial banks on COMEX. I mean, it just is. And one of the things that is, at least right now, somewhat hopeful is that the short position by the commercial banks on COMEX is the lowest or most bullish I have seen since 2019 in both gold and in silver. So the commercial banks are positioning as if they expect it to rise. The question becomes, when do they stop reversing course and come back in to short it again on rising prices? So hopefully they don't. I mean, a lot of the banks have made large investments in physical metal, like JP Morgan, who is holding over 1 billion ounces of physical silver and over 35 or 40 million ounces of gold. It's all told, the largest physical position of metal the world's ever seen. They are positioned for a rise in gold. And one of these days, and silver, they'll let them run. One of the reasons they haven't, Elliot, is that gold and silver are the canary in the mine shaft. Speaks to the fragility of the dollar. It's the emperor behind the curtain in The Wizard of Oz. He's talking all big with a big booming voice, and they pull back the curtain, just a little old man. Well, that's kind of what the dollar is, no one has looked behind the curtain, but that's what gold and silver do. They pull back the curtain. So by keeping them muted, it allows the game to continue, as it is the canary in the gold mine. So ultimately, as I've said many times, you can only manipulate a market over a period of time by pushing it in the direction that it is going. And that's the issue. At what point does the physical demand overwhelm the ability to hold it down in the face of a falling dollar? So, one of these days, the commercial banks will let it run. They're positioned to let it run right now. The question is that short term? Do they reverse course? Is it more of the same thing? Or one of these days, is it the one moment where they let it run and don't look back? And it's getting very dangerous and very risky to continue suppressing a price in what is a global issue of inflation and potential de-dollarization epidemic, where the world is just sick and tired of holding dollars, a losing game, and start to move to something else like gold. That's when the tide changes. So at least right now in the short term, the backdrop looks incredibly bullish.
It really does seem like the perfect setup for this. Last time we had stagflationary supply chain geopolitical issues like the 1970s, gold absolutely skyrocketed. So it's worse now. I think, like you were saying, inflation measured today is the worst in US history, right?
Right.
Because of the way it's measured compared to the past. So
right.
Wow, absolutely incredible. Where can people go to buy physical metals if they want?
Well, we've talked about before, we're getting very close to launching our new website. In the meantime, all they need to do is send us an email at info@milesfranklin, mention the early stage investor in the subject line. We will answer all of your listeners' questions, make sure they get the best price, and make it a good experience. We've never had a customer complaint in 33 years. Your listeners won't be the first. And we really appreciate the opportunity to work with them, Elliot, and help educate them at the same time. We're not order takers, although we will place an order if someone asks for it. We'll also educate them on the reasons why to own precious metals, like we're talking about here. Also, the do's and the don'ts and the types of product to own, and pluses and minuses, all of the things that you need to know when buying gold and silver. That's what we shine in. That's our strong point. So very happy for the opportunity to work with your people, and always great to see you and chat each week. And certainly look forward now that I'm back in town to seeing you on a regular basis.
It is a good opportunity to educate people because you're right. Not many people are talking about this. And if you had just listened to the mainstream talking points, it's inflation is transitory, it's inflation is good, and now it's Putin's fault and it's going to go away. And so it's just nonstop.
No, the famous Austrian economist Milton Friedman said very succinctly that always the inflation is always a monetary event. Always. It has nothing to do with Putin. It has nothing to do with the supply chain issues. Those just exacerbate the problem. But always, inflation is a monetary phenomenon. And it just means that the Fed created all of this money. There's your monetary phenomenon. That's why there's an increase in prices. Inflation is an increase in the money supply. The supply chain problems just exacerbate it because you have fewer products to be bought with all the increase in the money. So it's an exacerbation of the issue. The issue is the increase in the money supply. Yeah. So if you had a stagnant money supply and supply chain problems, you would have price inflation, just simply because there's more money chasing fewer goods. But when you increase the money supply, that's inflationary. Now you add the supply chain issues, and it's only exacerbating the inflationary issue. So it is always and everywhere a monetary phenomenon. Whatever Putin is doing and all of the other issues just add fuel to an inflationary fire.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.